Hey everybody, Dr. Phil here. It's going to be a quick video on job order costing. So let's get right into it. So what is job order costing? So we can think of job order costing as custom made things, made to order. Back in the day, you used to be able to order a computer from Dell.com, and you could specify, you probably still can. I want this, I want this, I want this many gigs of hard drive, I want this kind of RAM, etc., etc., right? So everything you do, you're making it more specific. So that's a good way to think about job order costing compared to process costing. Process costing, we'll talk about that in a different chapter, but that's more of a mass production type of thing. If you look down here, you can see some examples of job order operations, right? As I just said, custom orders. Let's make this a little bigger. Diverse products and services, like think about a range of different products, low production volume. And then what we're doing over here is we're kind of comparing the two, right? So, custom orders compared to process operations, repetitive procedures, right? Diverse products and services, similar products and services for process operations. Low versus high production volume, right? High flexibility versus low flexibility, and low standardization and relative to high standardization. So, like I say, the one that we're going to focus on in this video is job order costing, job order operations. Okay, so let's look at some production activities and job order costing, right? So we've got these different types of inventory accounts, right? Work in process inventory. Think of work in process inventory as the assembly line, and then think about finished goods inventory as a warehouse. The stuff's being done; it's just waiting to be sold. So, what's going into the production line? Work in process inventory. So, direct materials, of course, direct labor, the two direct costs, and then everything else as overhead, right? So, some examples we have here: indirect materials. Think about materials that we just use a kind of a small, trace amount of. Indirect labor, maybe labor that's not easily tied to any one specific product or even assembly line, but we, of course, still have to account for that. And then any other types of indirect costs. Okay, so once these, let's say, like if we look at job B15 here, this red SUV, it's completed, it's moved over to the warehouse, finished goods inventory, and then it's delivered, right? Then that cost is then transferred to cost of goods sold. Job B16 below it, it's like a little small SUV, maybe a sedan. It's completed, it's been painted, it's done, it's just sitting in the warehouse, it's not been sold. And then job B17, this truck, you can see here that that's still being worked on. So, kind of point being that at any given time, you're going to have stuff that's been sold, you're going to have stuff that's sitting in the warehouse ready to be sold, and then you're going to have stuff that is still being worked on. So cost flows. So manufacturing cost flows. So number one, raw materials inventory. Think about the storeroom, the stock room where they store all the raw materials before they're issued out into production. That's where we're going to keep our direct and indirect materials. Number two, work in process inventory. So again, think of this as the assembly line. The job is currently being produced. Number three, finished goods inventory. That's where the goods are completed. Again, think about that like the warehouse, like I was just saying. And then number four, cost of goods sold. The goods that we've now sold, we've now got revenue to match that cost against, so that cost is transferred to cost of goods sold. And then it says down here, subsidiary records store specific cost data about the manufacturing costs for each job. So think of subsidiary records as in accounting, we have this, we call it parent versus subsidiary. So the parent would be kind of like the record of everything in that category. The subsidiary would be like an individual, record, if you will, of something in that category. So for example, if we were talking about accounts receivable, the total accounts receivable balance, like all the money the company is owed from everybody, all their customers, that would be the parent amount, if you will, just that total accounts receivable balance. And imagine like you double clicked it and it dropped the list down of, okay, so and so owes us this much, so and so owes us this much. Those would be examples of the subsidiaries. All right, so this is an example, just an example of a job cost sheet. Again, this is not doesn't mean you'll see this when you get out if you go to work for a manufacturing enterprise. Every company has their own version of this, but this just kind of gives you an idea as to what are some of the pertinent information that would be on this. So obviously customer's name and address, right? The job description, the date they promised it, the date they started it, the date they completed it, obviously the job number here, B15. And then you notice again these three categories, right? Direct materials, direct labor, and overhead. So you can see for this one, they had $700 worth of materials based on requisition slip R46. They've got $1,000 worth of direct labor in this job based on time ticket T33. And then they have overhead, which now notice here they're charging overhead, and every company does this differently. They're charging overhead at the rate of 160% of direct labor cost. So look at the direct labor cost, $1,000, right? And then just times it by 160%, or just 1.6, and that's going to give you the overhead cost of 1,600. So we have 700 for materials, 1,000 for labor, 1,600 for overhead, and you can see where they put these down here: materials, labor, overhead. We add these all up, and we have a total cost for this job of 3,300 bucks. All right, so let's talk a little more about materials and labor costs. So materials that are received are recorded in a receiving report. So think of a receiving report as, you may have heard the term shipping and receiving. Think about like you've driven past a business, like a factory, for example, and it's got a loading dock. So think about like shipping, going out, receiving, coming in, shipping and receiving. So when goods are received, it makes sense that the company would want to check them, right? To make sure that they're good, they're saleable, they're in the condition they expected, they got the quantity they expected, so on and so forth. So that's what's recorded in a receiving report, right? So this is another example of what we call a source document. So this is something that we could go back and look at to verify, to corroborate the accounting records. And then materials ledger cards. So these are updated when materials are purchased and then they're issued for use in production. So as an example, so let's say that they purchased, in this case, $2,750 worth of raw materials. So they debit or increase the asset account raw materials inventory. You can see here it's being debited, and then they are crediting accounts payable. Remember what accounts payable are? That's accounts that you owe, money you owe other people. So obviously they've purchased this on credit, so they're going to have to pay for this in the future. Okay, and then below it you see an example of a materials ledger card. You can see the item, the quantity, the stock number, the minimum quantity is 1 unit, right? The location, so if they so they can easily find it, and then the reorder quantity of 2 units. Right, so you can see here like received on the left, issued in the middle, and then you can see the current balance on the right hand side. So here's an example of, well, actually 3 examples of, we can just look at one, materials requisition slips. So think about what the word requisition means: to require. So production requires materials, right? So when production requires materials, they go to the kind of the storeroom, the stock room where the raw materials are sitting, and kind of say, hey, we need X amount of materials for, Y job. And this is really what they're documenting here, right? So on March the 8th for job B15, the person that requested it was somebody Luther. It was filled out by Bateman. This is probably somebody that works in the storeroom. And then this is what they wanted. They wanted 1 unit, which was an alarm system, part number M3, and then they wanted 4 units of paints, part number P2, and then they've got the total cost of the materials that they are requisitioning. So what about the journal entry for the requisition? So what they would do, the first thing they would do is they would say, okay, well, what requisitions did we have? We had a $700 requisition for B15, $800 for B16, and then $300 for B17, right? So total requisition of $1,800. So what they're going to do here is they're going to debit work in process inventory. Again, that's an asset account, so normal debit balance. So they are increasing work in process inventory, and then they are decreasing another asset account, another inventory account, raw materials inventory. So what they're basically doing here is they're recording the transfer of materials from direct materials in this case, from the storeroom over to the production line. All right, so that's a little bit about materials. Let's just talk a little bit about labor costs now. So you can see we've got time tickets over here. So time tickets are recording the direct labor. A lot of that now is going to be, of course, done electronically. And then for indirect labor, a lot of some of the salary people are likely going to be indirect because they're probably, not just working on one product, if you will, one line. They're working on a lot of different things. So those salaries, those expenses have to be recorded as indirect labor because it's not always easy to trace those. And then we may also have other time tickets that could also constitute indirect labor. So here we see an example of a labor time ticket, and kind of like I was saying about the kind of like I was saying about the materials rec forms. Don't take any of these to the bank. I mean, you go to work for a company, it's probably going to have the same kind of information on, but their layout, their format, exactly what's on here may be a little different. So you can see if we just look at the first one. So the employee name was T. Zeller. Their employee number is 69. The job they were working on was job number B15. Date was March the 12th. And then if you come down here, you can kind of see what all they were working on. So like on March the 10th, right? They spent 8 hours at an hourly rate of $50. So they charged $400. And then March the 11th, kind of the same thing again, another 400. And then on March the 12th, another 200. Right? And this is all being charged to job number B15. And it would be the same thing with these two behind it, T34 and T35. So what about the journal entry to record the labor? So you can see the three jobs here we just looked at, B15, B16, B17. So the total direct labor cost for these three jobs was 4,200. And then you see over here where they've debited work in process inventory. So they're increasing the asset account work in process inventory. And then they are also increasing the liability account factory wages payable. Now think about why that's a liability, because they haven't actually paid these wages yet. They're just recording that they now owe these wages because the workers have performed the work, right? They've done the service, they're owed the money, they just won't be paid until the next payday. Okay. All right, overhead costs. So the first thing that the company is going to do as far as overhead costs is they're going to, number one, they're going to determine whatever their predetermined overhead rate is. Now you notice one of the examples we looked at previously in this video was they were using 160% of direct labor. Now companies all over the world are free to choose, well, manufacturing companies are free to choose whatever system they like to determine their overhead rates. So number one, they're going to predetermine their overhead rate at the beginning of the period, and then during the period, they're going to apply the estimated overhead while they're recording the actual overhead bills. So there's different reasons why they do that. One of the reasons is, if you didn't apply overhead during the year based on what you think the total amount's going to be at the end of the year, then you would have to kind of wait until the end of the year to really know what your bills were. So obviously, you can't do that. Also, some of these bills, things like electricity, possibly water, some of them are prone to seasonal fluctuations, right? Like in the winter and in the summer, your bill's probably going to be higher. So one of the things we like about the sort of applying the overhead evenly over the year is it kind of smooths out those seasonality fluctuations. And then number four, at the end of the period, they'll close the overhead. They'll just look at what they applied, they'll look at what the actual amount was, they'll compare, and then they'll make an adjustment to close that out. And we'll look at that a little bit later on in this video. So as far as calculating the predetermined overhead rates, pretty easily actually. They just look at their estimated overhead costs, and then they divide it by the estimated activity base. So whenever you hear the term activity base, I know it sounds like a bit of a weird term. Just think of what is driving the overhead. Is it, if you had to pick like one activity, just one, what is that one activity that's most driving the overhead? So it could be direct labor hours, it could be machine hours if you have more, sort of mechanization in your facility. So the first thing you do is you figure out the predetermined overhead rate. And then as far as the applied overhead goes, we're going to take the overhead rate from here and then times the actual amount of the activity base used. And we'll look at an example of that because, again, they always make this sound way more complicated than it is. And you'll see as we look at an example in a second, it's really not that difficult. The last thing we'll do is we'll close the to cost of goods sold, the difference between whatever the actual overhead was and whatever the estimated or the applied overhead was. So the first thing we'll do is set the predetermined overhead rate. So this company, Road Warriors, uses a predetermined overhead rate, POHR, based on direct labor cost to apply overhead to the jobs. So the predetermined overhead rate is going to be the estimated overhead cost. So you can see here, their estimated overhead for the year was 200,000 divided by the estimated overhead base, which was 125,000. And then we plug in your numbers, right? And then we get 160% or 1.6 times. So what we're really saying is our estimated overhead costs are going to be 160% of our estimated overhead base. And again, the overhead base is typically going to be either direct labor hours or machine hours. So as an example, so you can see here they're using direct labor cost. So think about where this is coming from. This POHR, predetermined overhead rate, 1.6, right? We just calculated that. That was the 200,000 divided by, if I go back real quick, the 125,000 here. So what they're saying is, if you, like for job 15, if they incur $1,000 worth of labor cost, then what they're going to apply to cover the overhead is 1.6 times that, right? So 1,000 direct labor cost times 1.6, 1,600 to cover the overhead. And then for B16, now it's 2,000 labor hours. So again, times 1.6, they're going to apply, if they work 2,000 labor hours, they're going to apply 3,200 to cover the overhead. And then for B17, finally, they worked 1,200 hours for that one, labor hours, times 1.6, so they applied 1,920. So if you add the total amount of applied overhead, it's going to be 6,720. That's, of course, these three added together. So then they debited work in process inventory. They increased the asset account work in process inventory with debit, and then they credited the factory overhead. And again, this is just to apply the overhead for those three jobs. So again, what you're seeing here are not the actual, they're not the actual overhead bills. Okay, they're recording those, but they're kind of doing that in the background. They'll make the adjustment at the end of the year. Okay, so as far as the actual overhead goes, there's really three things: indirect materials, indirect labor, and then any other overhead costs that we need to think about. So recording indirect materials used. So again, when you think of indirect materials, think of anything that they use that maybe just in very small, like, almost trace amounts. And then think about, it may be hard to quantify some of these amounts because they're very small. So it's often easier just to record this as part of the overhead rather than trying to make it part of direct materials. So what we're doing here is the company is debiting factory overhead, and they are crediting raw materials inventory. Okay, so what they're basically saying here is they took $550 worth of stuff out of raw materials inventory. Right, this is a credit to an asset account, so it's going down. So it's coming out of raw materials inventory, and it's being added to the factory overhead account. In this case, 550. And as far as the indirect labor, so they're saying here, okay, we have $1,100 worth of indirect labor. So we have a debit to factory overhead. Again, the amount is being charged to factory overhead, and it's being credited to the liability account, factory wages payable. So the liability account, factory wages payable, is being increased because, again, this is $1,100 that the company is going to have to pay that they haven't paid as of yet. And then finally, just record any other overhead costs that they may have. So you can see here some of the other ones. That probably in real life, in actuality, there'd probably be a lot more than this, but this just kind of gives you an idea. They're probably going to have an amount for accumulated depreciation for the factory equipment as they think about how they depreciate that over time. Rent payable, utilities payable, prepaid insurance. So again, we've got a couple of liability accounts here that are being increased. Prepaid insurance is an asset account. This one is, of course, going down because an asset account is a normal debit balance, right? This is a credit, so it's going down. And then all these amounts added together is going to be your 5,270, and they are also adding that to, or they're charging that to the factory overhead account. Again, these are now all the actual costs. Okay, so a couple other things, and then we'll wrap this one up. Cost flows to the financial statements. So you notice that a lot of time is spent on the balance sheet, and then it finally goes to the income statement. So we think about it going to the income statement once we sell it. Okay, so you can see here the balance sheet. You can see the three different types of inventory accounts: raw materials inventory, work in process inventory, and finished goods inventory. So you can see over here where they've got, now remember, these are all asset accounts, right? All three of these inventory accounts are asset accounts. So they're debited or increased on the left here, and they are credited or increased on the right-hand side. So if you want to make raw materials inventory go up, you would put it on the left. And if you want to make it go down, it would be on the right. And it would be the same for these two as well. So this will make sense, right? Because beginning purchases, that would make your inventory account go up. That, of course, is what you had left over from the last period. Any materials that they purchased, and then anything that went out from raw materials, of course, is going to make it go down. So like here, they took it out of raw materials inventory. They added it to work in process inventory. So of course, that would make it go up. Cost of goods manufactured. So think of what they've completed on the assembly line in work in process inventory. You could say really either way. And then transferred over to finished goods inventory, cost of goods manufactured. And then finally, now again, think of finished goods inventory, think of this one as the warehouse, and then think of cost of goods sold as stuff that they've now sold and it's now being taken out of the warehouse. Hence, this account needs to be decreased. And then it's transferred to the income statement, cost of goods sold. One other thing I'll say about these three real quick, these three are asset accounts. Now, the company owns this stuff until right here, right? When they sell it, then it's transferred to cost of goods sold. But up until that point, all this stuff belongs to the company, right? So it's appropriate, it's justified, it's warranted, if you will, that all this stuff belongs on the company's balance sheet. As soon as they sell it, it's no longer theirs, right? The title, legal title to the goods has been transferred to somebody else. Excuse me. So that's where cost of goods sold comes in, and now it's been removed from the balance sheet and it's being expensed on the income statement through cost of goods sold. All right, so this is just kind of showing, this might be something that you want to go back to once you watch this video through. This is just kind of showing all the different things that we looked at in the video, and there's a little legend down here, which is probably pretty helpful. So you can see here, for example, number one, materials purchased. And you can see up here in the raw materials inventory account, again, asset account, normal debit balance. So this is going up, this is increasing it. It would make sense if you're buying materials that this would go up. Number two, direct materials used. You can see here, this is making raw materials go down. And that's being transferred over to, again, work in process. What is that? That, of course, is the production line. And then number three, direct labor used. If we look for direct labor used, and we're looking for number three, you can see it down here, factory wages payable. It's being added to work in process inventory. Number four, indirect materials used. You can see here, indirect materials coming out of raw materials inventory, going into factory overhead. Number five, indirect labor used. You can see that one at the very top on the right-hand side. On the credit side of factory wages payable, also going into factory overhead. Number six, overhead applied. You can see that here, the 6720. And then that's being transferred over to work in process inventory. And then let's see, number seven, any other overhead that they used, any other accounts, you can see it was transferred to factory overhead. Number eight, finished goods. So this is where we're transferring $9,300 worth of units, goods from the warehouse, from the assembly line, work in process inventory, over to the warehouse finished goods inventory. And then number nine, when it's finally sold, then in this case they sold $3,300 worth of stuff. It's being transferred from the warehouse. Now it's being sold over to cost of goods sold. So here's a schedule of cost of goods manufactured. These are all the numbers that we looked at in the video. $1,800 worth of direct materials, $4,200 of labor, $6,720 of applied overhead. So if you add those three up, direct materials, direct labor, and overhead, we get total manufacturing costs of $12,720. There was no beginning inventory and work in process. So that's 0. So obviously our total cost of work in process is the same, 12,720. And then we just say, okay, well, what was our work in process inventory ending? And we had 3420's worth of stuff that we are still working on that will be finished, completed most likely in the next period. So our cost of goods manufactured was 9,300. All right, we're almost done. Just a little bit about the financial statements. At the end of the period, the income statement is going to show cost of goods sold, right? You can see here 3,300. If I go back real quick, you can see, let's see, there it is, 3,300. You can see where they transferred 3,300 from finished goods inventory, right, the warehouse, over to cost of goods sold. And then you can see over on the right-hand side, we have inventory balances on the balance sheet. So 1,400 as of the last day of March, 1,400 in raw materials, 3,420 in work in process, and 6,000 in finished goods inventory. And again, you can see that here, right? So 1,400, there's your 1,400 in raw materials inventory. Work in process is 3,420, and finished goods is 6,000. So again, those will just be transferred over to the next period. Okay, the last thing we'll do, and then we'll be done for this video, is adjusting factory overhead. So we've kind of talked a little bit about the factory overhead account. We have what we do here is we record the actual costs on the left or the debit side, and we record the applied costs on the right or credit side. Okay, so what we're going to end up with here is, unless you were like exactly right, which never happens, you're either going to have under-applied overhead or you're going to have over-applied overhead. And you can see down here that if there's, let's say that your actual overhead was more than you applied for the period, what this really means is your actual bills for the year were more than what you applied, then you would have a debit balance because you'd have a greater number on the left-hand side, right? Debit side here. So therefore you had under-applied it, right? Like you hadn't applied enough during the year. Thus, in that case, jobs are undercosted because the actual bills were a little higher than what you applied. So the journal entry there to correct that, let me get back to where we were, there we are, is a debit to cost of goods sold to increase the cost because it was undercosted, and then a credit to factory overhead. If it's the other way around, we just basically reverse it, right? If the actual is less than the applied, there's now going to be a credit balance, right? Because there's going to be more on the applied side, right, over here on the right or credit side than there is on the left. In that case, in that scenario, we've over-applied it, so therefore the job is overcosted. So now we're going to debit factory overhead, and we're going to credit or decrease cost of goods sold. So here you see an example, right? So we've got factory overhead, we've got the factory overhead account. You can see that there was 6720 of overhead applied. That was the scenario we've been working on here. And then you can see that if you add up all these, this obviously would be 6920, right? Let's see, 66, yep, 6920. So you can see here that we have 200 more on the actual side. Remember, the actual side is the left, the applied is the right. So we've got 200 more on the actual side. So what we're saying is we under-applied it by 200. We should have applied 6920, but we only applied 6720, right? So we basically got a $200 debit balance over here. So the way we're going to fix that is we're going to debit or increase cost of goods sold, and then we're going to record the credit to factory overhead, and that's going to basically zero out factory overhead, ready for the next period. And then we've now recorded that extra 200 bucks of cost. Okay, that's the video. Take good care.